Ladies and gents, another day, another hot one. Another hot one for you. Amazon reporting earnings after hours. I see a sea of red right now. Good golly. I mean, it looks like we just jumped off into the Marianas Trench, is what it really looks like. There's your normal ocean floor, and then there's Marianas Trench. So down 5% in after hours trading so far. And I think there's, just based off of this, I haven't peaked. I'm reading it first time with you as I'm reading it, okay? Look, I'm honest here. Couple reasons why I think this is possible. I think as a whole, we've seen this entire week, we've seen a lot of great earnings reports in which the stock's still gone down just because expectations are so high, and there is, speaking of tough comps, look at the flip. Look at the flip of the wrist, man. That's the song, right? Anyways, freaking neutral now. Anyways, down 4% again. What's going on? You can't trust Google. That's why I hit enter randomly. But, yeah, that's my opinion on that. Could have been a bad earnings. I don't necessarily see a bad earnings out of Amazon right now. I predicted a good beat on revenue as well as an EPS beat. Let's see why the stock's down here. Let's just take a peek, all right? Eyes closed. What do we see here? Quarter two GAAP EPS of $15.12. Beats by $2.80. And a revenue miss. $113 billion, up 27.2% year over year. Misses by just under $2 billion. Holy crap. This is bad. So I see why we're getting this this reaction here. That's not good. That's not good. Amazon doesn't miss consensus. They don't do it. It's just not something they've historically ever done. If you look at previous earnings reports, they're going to beat really probably 99 times out of 100. I was going to say 9 out of 10, but it's more than that, frankly. Operating income came in at 7.7 versus a consensus of 7.82. Just low. And for the guidance, this is weak stuff. Expected 106 to 112. Which is a 10 to 16% growth versus a consensus of $118 billion. Yikes. And this is where you get into the situation where you have extremely tough comps. Now, really, if you look 2 years out from 2019 numbers, this is fantastic growth. Ridiculously fantastic growth. But that's not something that really Wall Street sees, unfortunately. They're taking it as just what's happening right now. They're taking it as slowing growth rates, which frankly it's not. They're temporarily slowing growth rates because of last year's tremendously strong growth rates. Look, it feels like it takes a rocket science to do that. No one in Wall Street, frankly, no one there has an IQ over probably 50. We'll be clear with each other. There's zero critical thinking going on here, and we just look at the doom and gloom. It's all people do. So pessimistic, so weak, so weak. Now I'm done ranting here. Operating income here of 2.5 to 6 billion. Pretty weak there, I can't lie to you. I would expect a better number there, frankly. Let's see what the net income brings in too. But let's look at the press release. Boop. Zoom in even one more for you because I care. This is because I care about you. Operating cash flow increased 16% to $59.3 billion, so that's good to see a year-over-year growth there. For the trailing 12-month number, yeah, we like that. So that's a solid sign there. Free cash flow as a whole decreased to $12.1 billion compared to $31.9 billion for trailing 12 months. So that's concerning, no doubt. Yikes. Yeah. Ooh. But obviously this is incredible growth here. The 27% growth already over an $88 billion number. And that's something too. The percentage growth shouldn't be what people are looking at here. You talk about the dollar growth here. It's freaking incredible. We're talking about adding nearly $30 billion to this line, $25 billion added. And you're upset about that? Growing $25 billion if you're looking year over year? I don't get that. Net income at $7.8 billion. I'd like to see it a lot higher with this company, frankly. The net income line is pretty weak. Obviously, EPS is high because of the reduced amount of shares. Obviously, a lot less shares trading here, which is why you see such a higher EPS line. So it seems pretty high, yet the net income Still not quite where I believe it could be for this company. We're talking about a revenue of $113 billion, yet only bringing in $7 billion in net income. It's somewhat disappointing in my aspect. That's why I really think this company can improve on most is going to be this net income line. And really working on the printing cash model. I think they can get that for sure. But some of the highlights, we're not going to talk about employee safety and providing good jobs. That's just, feeding BS to the investors. That's really what the main thing is, though. That's the whole point of press releases, is to feed BS to them to make them buy into the stock. Yet you're not making anyone buy in with this report, unfortunately. Economic impact, I mean, come on now. Supporting communities, that's got nothing to do with the stock. It's just wasting money. Woo! Sorry, that's rude of me. Protecting the planet. Have I talked about wasting money again? You see what I'm doing? I'm blasting them. That's funny. Nothing crazy here. Oh, don't you dare talk about the Tomorrow War with Chris Pratt. Both #1 stream movies on their opening weekends. Well, guess what? It was the only movie streaming during that time, and it was absolute pure garbage. Look at the ratings on Tomorrow War. Amazon Prime. Then you can talk about, Prime Video can then they can flaunt it. But it wasn't. So kind of a bunch of nonsense here. Amazon Web Services we like to talk about, but I believe they'll break it down later in an actual chart. We don't want to talk about guidance because obviously pretty disappointing here. Pretty disappointing. What can I say? Let's see if we can find a breakdown of the revenues here. So we can see an overall breakdown of these expenses here. That's one thing to look at. Marketing, pretty high number into marketing there. Can't lie to you. Technology and content is a number that's going to continue to grow. Obviously, they spend more on content. It's probably the biggest portion of that grows, no doubt. Net sales, obviously good to look at because you can see in terms of North America and international, that's all they do for segments. Nothing crazy there. Overall, in general, numbers are growing. I mean, what can I say? Growth in North America, growth in international net sales. So it's positive to see in that aspect, for sure. And even the operating income line grows as well. Amazon Web Services obviously is one thing I always talk about here. Cloud is it's a pretty good sign for them. They're growing the cloud business quite well. We're talking about $14.8 billion this quarter compared to 10.8 of the year prior. So that's magnificent growth from Amazon Web Services standpoint. If you're talking about 40% growth, I'm not upset about that. So I think that's still a good line for them, and cloud's great for them. You look 6 months ending, still a great story here too. Growth of $7 billion there. So it's what I like. It's what I like to see. Here's the balance sheet. It's a pretty big one, obviously, as this company's massive. Total current assets right now on the far right here, sitting at $140.8 billion compared to $132.7 billion. Most of the growth here in marketable securities as a whole. So good growth there. We'd like to see it. Total assets in general sitting at $360 compared to $321. When you talk about a 6 months comparison, that's quite a great improvement here. From property, operating leases, they've grown in every single area here from an asset standpoint. So it's good to see that. Likely might see total liabilities go up, but we'll see what's going on there. Current liabilities, though, did not seem to grow. 117.7 compared to 126.3. So a decrease there. Looks like they paid off some accounts payable. Good to see that. And from a long-term debt standpoint, you saw a growth here around $20 billion. Really $19 billion if you want to be fair, but that's okay. And other long-term liabilities also grew. But in general, the stockholder equity saw a great rise over the last 6 months, $114 billion compared to $93 billion. So this balance sheet's in a really good spot. And again, I think this company can easily transition to even a more profitable model than they're at, which is it's already very profitable. We can't lie. When you're bringing in billions of dollars in profit and net income, you're happy about that. You look at the stock itself. Let's be clear. I know why this stock's down. $1.8 trillion valuation on this company. With the P/E ratio at 68, not really changing at all by those standards. Still going to be over 65 after today, depending on what it opens up at tomorrow. I'm curious to see what that looks like, but not super exciting from my perspective. look, you look at the stock and an overall general revenue here. Likely this year going to be putting around a $420 to $450 billion number. And trading at a market cap of 1.8 is not incredibly expensive, all things considered. We're talking about trading at 4 to 5 times that value. So it's not crazy expensive. But this reaction is solely due to tough comps. I mean that's what's been killing these companies this week, has been guidance that has been actually, by all standards, when you're looking from a 2-year annualized growth rate comparison, it's beautiful. I mean, it is ridiculous how much these tech companies have grown in the last 2 years. Yet everyone in investing is unfortunately short-sighted. The big hedge funds, they're all short-sighted. That's where you see these declines. I don't dislike Amazon stock really at these levels even, because I think there's a lot of room to grow. Don't mind me breaking my toe on the desk, but it only hurts a little bit. Investors, look, you're all shams. You need to learn how to invest some money, because you don't know what you're doing right now. That's all I got for you today. Hope you had a good one.